Hi, thank you for joining us. Today we will present our stock pitch recommendation for Domino's Pizza, ticker symbol DPT. Our team analyzes its industry position, financial health, and valuation to determine whether it's a good buy. So here's a quick review of our today's presentation. We'll walk through our investment thesis, industry outlook, company background, financial and valuation analysis, and then close with our final recommendation. So Domino's is a global leader in pizza delivery with over 21,000 stores across 90 countries. It operates with a capital-light franchise-based model and enjoy steady earnings growth and predictable cash flows. Despite its operational strength, our valuation shows that the stock is slightly overvalued at current market price. Between Shake Shack and Domino's, we believe Domino's is the safer pick due to its profitability and mature business model. Our DCF valuation estimates fair value at 414.54, just below the current price of 418.6. Based on its strong fundamentals and growth history, we recommend a target buy range of 400 to 450. So Domino's operates in the 400 billion US quick service restaurant market. Key drivers include urbanization, demand for convenience, and app-based delivery. Post-pandemic trends heavily favor delivery-focused players like Domino's, which is a long-term trend. So market size of 447 billion predicted to grow to roughly 750 billion in 2030.
Domino's Pizza was founded in 1960 in Australia and has currently grown to be the #1 pizza provider in the fast food industry. Additionally, it also ranks #9 in the fast food industry in total revenues, boasting sales of around 10 billion. It is planned growth over year to year is 15% based off of recent quarterly reports. In the SWOT analysis of Domino's Pizza, its strength lies in its strong brand recognition and strong delivery and carry-out services. Its weaknesses also coincide in its franchising model and also its reliance on core ingredients that could be vulnerable in recessions. Some opportunities for growth is some menu expansion and appealing to healthier foods. And some threats is that it's in an incredibly competitive industry and it lacks a lot of healthy food options, and recent economic downturns dissuade from delivery.
So this is the financial analysis recap. You can see that the return on equity of Shake Shack is around 4% average, while DPC is actually negative 13%, which is because the company keeps on buying back stock, so the profits are positive. The times interest earned is 4 to 5 times, whereas Shack is around 11.95, and the current ratio is 0.56 for DPC, while the debt to equity is negative, which is also because of the heavy buybacks, not an operating weakness. While the bottom line is that DPC is turning leverage into higher share returns while still covering its debts. So the conclusion is that the profits are pretty solid, but the capital structure is intentionally more aggressive. Liquidity is it deteriorated sharply in 2024, while the low interest coverage is relatively low compared to Shake Shack, and the leverage could be a hindrance to the flexibility in economic downturns. So our assumptions for the DCF are that it's a forecast horizon of around 5 years from fiscal year 24 to 28, while the tax rate is 21% and the WACC is 6.5% with a terminal growth rate of 3%. This is our DCF valuation results with a base value of 415 compared to the market, which is 418, which is essentially a fair result with small tweaks. And the WACC of 6%, it can move the value more into the mid 430s, but overall it's still a fair valuation.
A lot of analysis have Domino's Pizza interesting value low in like 432 and with Zach's value score of it doing steep, but a lot also have it at high with tip ranks, price target, and analysis Yahoo Finance around 507 to 519. A lot of analysts agree that it has limited upside, but its growth is mostly priced. It has mostly priced in growth. And additionally, Warren Buffett and value investing considers them a good investment, with value investing doing its own DCF valuation, resulting in 11.7% upside. In conclusion, Shake Shack and comparing Shake Shack and Domino's Pizza is a significantly safer choice as it is selling at fair value, while Shake Shack is overvalued by a large percent. Compared to Shake Shack, however, Domino's Pizza has slight risk associated with definite competition, but considering its predictable cash flow and low business model, DP's Domino Pizza is regarded as a safe buy. There's a lot of upside potential, proven by its historical consistent earnings growth. And that is our stock pitch on why Domino's Pizza is a good buy right now. And here are references. Thank you.